Good morning, ladies and gentlemen, and welcome to the FY 2019 Annual Results Presentation, Conference Call and Live Webcast. I would like to remind everyone in the room that this session is being recorded. Before we start the proceedings, I would like to kindly request that you switch off your mobile phones and any devices. Michael. I would also like to bring your attention to the disclaimer up front. I'm not going to spend any time reading through that, but please note the safe harbour statement. Please note that the presentation material, as well as the full results announcement and additional information, are all available on our website. And with that, I would like to hand over to Mr. Darby de Villiers, Chief Executive Officer. Thank you.
Thanks, Akira. All right, good morning. Thanks for attending. Really appreciate it. It's an honor for me to be up here and be able to share our annual results with you. We'll spend some time on the annual results, but we'll also spend some time on the strategy and where we want to take the business. So Bruce will do the results, and I'll end off again with some concluding remarks and some bit of the future. Before I get to the results, it's maybe appropriate to give you a little bit of a sense of my first 6 months. I've just been in the job for just more than 6 months now. Year end was 5 months. Most of the questions I get is not about the strategy; it's about how was it for you. So maybe I'll up front on it. Look, I think I spent a lot of time initially, especially with clients and with staff. I thought those were the two most important points for this business, where it was at the time. Also for me, in the way that I want to operate, I want to understand what our clients want, what we need to deliver for them, what they're feeling, and especially the staff. Staff is our asset, and we need to know what makes them tick and how to get them motivated. So I spent a lot of time, probably an inordinate amount of time with the staff and with the clients, but I felt it was very valuable. I think I got very good insights. Could collaborate with the staff internally and with management to see what the road forward is, and I think we crafted quite a nice solution given that feedback from staff and from clients. So that was, in my mind, time worth spending. It'll be wrong of me to say that it say that it wasn't tough. I think this first 5 months was really tough for the organization, tough on the staff, a lot of uncertainty for staff, tough on the clients, who hears a lot of rumors, hears a lot of noise, and they've had to deal with a lot of media attention as well. So that was tough, and then also we had the economic conditions that also made it quite hard for us. So it was difficult. We also had to do a lot of things at the same time. We had to change the culture, which was clear. There was a change in the culture, and the staff needed. We had to retain clients, make clients excited about our journey. So that took a lot of time, and at the same time design the roadmap for the future. So it was a busy time, but having said all of that, a very rewarding time. I'm very excited about where we are, very excited about the plans that we came up with, and hopefully you will also see the energy and the prospects in those plans going forward. Mostly excited about the caliber of people that is in this business, the quality of the business itself, the resilience of this business. That really gives me a lot of comfort and a lot of energy to be up here and to go on the way forward. So let's start with the slides. You've got some of it with you in the booklets. I'm going to walk around a bit just because I can't stand still. These are some macroeconomic variables that one can look at, and I specifically put those up. We all know in this room specifically how tough the year was, how tough the last 5 years was for us in South Africa, and I don't have to tell you any of that. But it's quite interesting to see if we look at this is just the 5-year numbers and the past calendar year numbers, and you can read for yourself and you understand it. But it's quite pertinent for us as a business of Alexander Forbes, who depends on quite a few things for revenue and for growth. But firstly, we depend on businesses being successful, businesses employing, the business environment to be successful, investments coming into the country. And those measures aren't positive. So for the last 5 years, the EB environment, the wholesale environment, has been under pressure. People employed less and less and less people, and less new businesses started up, which puts the environment that we're in under a lot of pressure. The rate of unemployment is actually a good stat, but the employment numbers and the people that are in employment is actually at an all-time low in South Africa, and our fees depend on rand per member per month type thing. It's the revenue driven by the number of members being employed puts a lot of pressure on our business. And then the last one, which we all feel and know and realize, it's still a shock when I see the number of almost 9% negative total returns on the all share for the capital year. Roundabout inflationary returns for the last 5 years in the market, and half of our revenue depends on asset-based revenue. That in itself puts a lot of pressure on a business like Alexander Forbes, and I think has been seen during the past few years in terms of the results. So on that relatively negative note, which we all know, but it's probably worthwhile stressing, to put that into perspective on the green block there, the environment is tough, and then we in Alexander Forbes sit with a maturing industry where there's a lot of competitors fighting for the same skills, fighting for the same clients. You hear that from other businesses as well, but this is quite a small industry, and that maturity we've reached that maturity level. A lot of regulatory requirements, especially in the insurance licenses. And then we had our own internal problems with management changes towards the second half of the year, which is well publicized and creates uncertainty in the business. So a very tough year for us as Forbes. But then we look at the results, and then I start getting a lot of energy and positive feeling. If you can get a business to grow by 6% revenue in these circumstances, quite exciting, and quite exciting for us. We spent a lot of time on client retention, and it isn't fighting to keep clients, it's actually changing our internal culture, our client-facing culture, and our people's behavior in terms of getting that positive feedback from clients. And we've been relatively successful in a very short period of time in establishing that with the clients and with the staff. Our new strategy has given the business a lot of energy. The talk about the strategy, the rollout of the strategy has given us a lot of energy internally and externally, and it's always great to get confirmation from outside our own environment and these walls that we are on the right track, and we've certainly received that, especially from clients, which again is a good indicator that we're going to focus on the right things to deliver value for them. So this has been very good for our business. Employee morale, long way to go. We know where we come from, but a big turnaround already, and that will translate into good service to clients. We always know that we're a good cash generation business, and then what excites me is the capital journey that we've started, initiated by the special dividend, and the intent being shown in terms of being capital light, what it means for us and the journey that we're going to walk on there. And Bruce will expand on that and the physical numbers. But for me, it's the message that we will understand very well every cent that we invest, where it goes, what's the return on capital needed to deliver, and can measure it and can target it. And that's the journey we actually want to be on, so that we understand our return on capital journey. You've seen the numbers; it's already in the sense, and it's said there. The profit from operations is down, as can be expected from the half-year numbers. The main message there is costs, and Bruce will expand on that, the expenses going forward and the expenses in this specific year, and Bruce will unpack that, which was the biggest item, obviously leading to the profit and operations dropping by 7%. These are some of the measures which we've quoted for you for a three-year period. We've also shown the discontinued businesses, the businesses put up for sale in green. And as you can show, they were actually quite a big contributor to the total results in all the metrics through the year. Very pleasing that the businesses are doing well, that the businesses are generating good returns, especially the short-term insurance business, which we're in the process of selling. Really remarkable how it's produced good returns and shows what a good asset it is. So especially for at this time and this period for a new buyer, it'll create a lot of value in their books where it is now. So that's pleasing. And then we show the dividend picture for the past 3 years there as well, with the special dividend of 30 cents. The cost-to-income ratio, as I said, Bruce will expand on. Just from my point of view, we know we have to get the cost down. We are targeting it. At the end of the presentation, I'll talk a little bit about our targets and where we want to be. This is indicative of a business that needed investment, that had a lot of once-off expenses in that we are looking at, and that we have to invest in for the future. So that number is by no means a good number or an indication of the future, but totally understandable where we are now. And I'm leaving all the difficult stuff to Bruce to explain later. We are moving forward in a new business environment, a new operating model, but because we operated in the same way during this year, we're still reporting through the businesses that we had, and I'll show you the results of each of the businesses and maybe make one or two comments. If we start with the C&EB business, which includes the administration, all the administration in there as well. Very pleasing results from healthcare. We're a strong player in the healthcare consulting business, up 10% new business, strong growth. So that's a very pleasing number. On the retirement fund side, in line with growth in the market of umbrella funds, our umbrella fund's grown very nicely. It's still one of the favorite umbrella funds in the market, doing well. So we're quite pleased with that number. And as I said, the 13% increase in cost is something that we will address later, but we must understand that we had to build for the future. We had to reskill the teams, upskill the teams, make sure that we have the right caliber of people in the business, and I think it's an investment for the future in terms of those expenses. On the investments business, good growth in revenue again. 7% growth in revenue, mostly because of the construct of the portfolios, the extended product offering going into higher margin asset classes like alternative asset classes. And again, I must say, one of the things that I investigated firstly when I came in here and looking after the investments is the first question that we should ask is how much value do we add to our clients? The second question is what is the revenue growth? And how we construct the portfolios is important, that we add value to the clients. Those two changes, plus some others, have added tremendous value this year for clients, and we think will in the future as well. We're uniquely positioned in our multi-manager construct to actually put alternative asset classes, more illiquid asset classes in the portfolios to the benefit of the members, and it's delivering the right return. So that is quite pleasing. And then it's very nice to see, we've had client losses and we've had very, very low new business, which has put a damper on, obviously, our assets under management, coupled with the bad markets. So the assets under management is lower, and that is something that we hope will recover over time. A lot of effort has to go into new business and retaining the existing clients. On top of that, we need some help from the markets. Very pleased with the Performer, our flagship portfolio. big growth in the portfolio, which is phenomenal, but also the returns. This is a multi-manager portfolio, and in the range of the portfolios that we measure ourselves against, we've been top 5 in a 1, 3, 5, and 10-year period, which shows that it is a consistent performer. It is, excuse the pun, it's a consistent performer that really gives value to clients. And our underlying growth strategy depends a lot on performance and giving performance through to individual members at the end of the day throughout their lifetime with Forbes. So this is critical for us to that this keeps up at high standards and increase even further. On the retail side, I mean, it's dominated by the great performance of the short-term insurance business. Through all the measures, and you can see in the green bars, done well, and that's very pleasing. And that's very pleasing in a tough environment with a lot of pressure on the business during the last year. So that's very pleasing results. Worth mentioning the first point there as well on the wealth side, our future strategy will depend on retaining more members from our wholesale member base into our products and into our services into the future. The preservation rate remains constant at 55%. We as an industry, and we certainly as Alexander Forbes, must up that preservation rate by doing cleverer and better stuff in the future, making it worthwhile for members to leave their assets in their funds and to preserve, not take it out in cash. And then the other element of it is actually those members that do leave their money, that they leave it with us, with our product, with our advice, and through the system with us. And if you combine those two, we've had a retention rate, a net retention rate of almost 24%, and that is something that we'll measure and target and give you feedback on a regular basis. I think we understand exactly what we want to do there. We understand exactly where we want to be and how we want to get there to get that retention rate up. So that's quite pleasing. One of the things that will get us there is our AFRIS product. AFRIS product launched less than a year ago, or just about a year ago, and it's already got, at the year ended at 2.7 billion, it's already got more than 3 billion worth of assets in there, which shows that we're on the right track with regards to individual members wanting to stay with us through their lifetime when they exit the funds. This is very pleasing, great product, well rolled out, and underlying returns good. And then the advice that comes with this is actually superior. So quite excited about integrating this retail solution into our wholesale offering, which is part of the future strategy. On the emerging market side, subdued growth. We're exiting some of the countries. Namibia under a lot of pressure because of their long recession that they've had there. Flat growth there, and we're continuing to look at exiting the Uganda and Zambia businesses as we speak, and that is progressing very well as well. Bruce will talk more in detail about the numbers, which is why you all came for. I just wasted your time for 10 minutes. So hopefully Bruce will enlighten you, and then I'll just end up again. Thanks, Bruce.
Thanks.
Good luck.
Thanks. I'll try and ensure that you stay awake through the numbers. It is the more boring side of the presentation. So the way that we've done the presentation, obviously you've seen in our segmental results that we present everything together. That's the way we've managed the business through the year. What we've done here is to try and present a split between continued and discontinued operations, which is what leads to the totals that you've seen. In our formal IFRS income statement, obviously, because of the discontinued operations, we've had to separate those two out. So when you read the IFRS income statement, you need to bear that in mind. I think what's important as well is to highlight how well the insurance businesses have done. As you can see in the discontinued operations, very, very good results on the revenue line and on the profit from operations. And that shows further down the income statement under discontinued operations. The other part of the revenue that I think is very important is to look at the disaggregation of our revenue and understand what is the driver behind those. We present two graphs there, which essentially shows you the services that we provide and the revenue associated with those services, and then how much of those services are actually based on a driver, which essentially is the assets under management at 56%, and then obviously the employment rate and payroll increases that we have within our client base. As Davy mentioned, he's left the difficult part to me, which is essentially to talk about the expenses. And I'd like to spend a bit of time on this slide because I think it's important that we understand what has happened and also the underlying structure within Alexander Forbes in terms of expenses. We did indicate at our interim results the fact that we had terminated our contract with on our IT modernization program, and that resulted in a 50 million rand contractual penalty clause, which essentially is sitting in our expense base. We also indicated in our interims the fact that we had a lot of consulting costs which were coming through our income statement, largely based on the previous Ambition 2022, which was a strategy that was in place at that time, and those costs were associated with things that they were trying to align in that strategy. In both of those cases, those costs were terminated at the time, and so we don't anticipate those costs going forward. Over and above that, I think it's important to look at some of the other cost line items on our income statement, and just to give some colour to them. Essentially, 59% of our costs are people costs. It is the majority of what we do. We provide services, and our people are a large part of that process. 6% increase in our people costs for the year. I think that there's a lot of analysis that happens underlying that number, specifically the fact that over the last 2 years we obviously have had significant disruption within our staff complement. We've lost a lot of senior leaders, and also we've seen a decrease in the actual underlying basic payroll costs. So the 6% increase actually comes from putting additional retention payments in place, which are some of the costs that have gone into that, as well as rebuilding the incentive structures that we've previously have been knocked through that process. So importantly, that 6% is really trying to rebuild and restructure our remuneration and to incentivize our staff correctly. We have a new remuneration philosophy which has been approved by the remuneration committee, and we still intend to build and stabilize our payments to staff going forward. Just in addition to that, we do still have capacity issues in one or two of the areas, specifically client-facing areas within the business, and the intention over the next year is that this cost line item will still remain under pressure. So just to highlight that. On our IT costs line, 25% increase is very high. Large part of that relates specifically to maintenance support costs. Once again, we've had a bit of disruption in the IT area with some senior leaders leaving, and we've made payments to external suppliers and contractors, which have been fairly expensive for us. The improvement process here is more structural than anything else, so it is going to take time to get it right. Our IT costs sit above benchmark in terms of the cost relative to our revenue, and we're aware of that. We've had a good number of discussions between myself and the head of our IT area, Sandra, and the intention there is to make sure that over time we structurally change the IT department and ensure that we get our costs back within a benchmark within the financial services industries. Another significant increase is the increase in our errors and omissions claims, which we've had in our income statement. We historically haven't really highlighted this, and if you look back in history, our historical run rate on errors and omissions claims is about 7 million rand a year. Over the last 2 years, those claims have increased significantly, and the current year we had a cost of 50 million rand in our income statement. Once again, we've done some root cause analysis on this, and largely relates to sort of disengaged staff and disruptions in our senior leaders. So the intention within this area is obviously refocusing, re-engaging staff, and trying to get our processes right to ensure that we solve that line item. Just carrying on down the income statement, just to highlight a few of the issues further down our income statement. I think our non-trading items, you will have seen at our interim results that we had a significant write-off in the software development that happened within our IT environment. The number that was disclosed at our interim was 287 million. What has happened in our income statement for the year end is that we have split that number between continuing and discontinuing operations. So of the 287 million, 150 million sits in the continuing operations area, 140 odd million has been taken down to discontinued operations. Included in that line is also the amortization of our intangible assets, which is standard every year, as well as the results from our E&O cell captive, which in the current year is 36 million rand profit. And then carrying on down the income statement, I think the other item to note is that our tax effective tax rate is very high. That's largely because our the impairment or the write-off of the software development is non-tax deductible. So if you remove that, you get to an effective tax rate that is 35%. The 35% is still high in our view, and certainly we have structural tax inefficiency within our legal entities, and we'll be addressing that through the current year. Profit from discontinued operations of 72 million rand essentially has got a lot of things in it. There's an analysis of this in our results announcement, and you know, the more you can find the details in one of the notes to the results. Essentially, the profit from operations, which you saw earlier on of 255 million, is decreased because of the impairment of the software as well as tax. And one of the other items that I need to highlight in that area is that we have finalized our sale of our Kenya operations and recorded a profit on sale of our Kenya operations of 56 million rand. So we've continued to repurchase shares through the year. Our share repurchase program purchased 29.5 million shares at an average price of 5.11 rand, which is the reason why our weighted average number of shares has decreased. That brings our headline earnings pretty much flat on prior year at 44 cents per share, and our basic earnings per share up 43% to 27 cents per share. We have highlighted here the normalized headline earnings per share, which is still a measure which we continue to use for our internal performance measures. The difference this year is not significant from the actual headline earnings per share, so we haven't spent much time explaining that difference. And our interim dividend that we have announced of 12 cents essentially brings the total dividend for the year to 30 cents, which is within the 1.5 times cover that we have indicated in our dividend policy. It is important to note that we have brought our dividends back within the dividend policy of 1.5 to 2 times cover, and that is our intention going forward, to ensure that we declare dividends within that range in the future. In order to distribute some of the additional or surplus capital within the business, we have also